can't get enough flowers in the U.S. of all the types you need. So it's just there's a sourcing shortage of certain varieties. Also, gas prices, heating greenhouses in certain areas, especially on the East Coast, the heated greenhouse is way more expensive than importing those flowers. And so the farmers know that, and they just don't heat them through certain months. And so you have to subsidize during certain times of the year.
Hey, real quick, you bootstrapped this company. You have funded it yourself, partly because a lot of VCs passed on this company.
Yeah.
What's the exit plan for you?
That's a good question. We should talk about that for a long time. I built it to sell. I don't know that that's the trajectory anymore for us, so we'll see. Building a long-term sustainable business, there's nothing wrong with that, though, and we don't talk about that.
Agreed.
It's not like the sexy, cool thing to talk about in all the magazines.
But I think that's because so many of these businesses are venture-backed, and they have investors breathing down their necks saying,
Absolutely.
we need our return.
Absolutely. I actually feel like we're extremely fortunate right now to not have that happening. A lot of my friends that are CEOs that have that same story, they are being forced to show some growth numbers, or at least a flat year. And our goal is a flat year this year with profit. But there's no path to profitability. Like overnight, they were expected to make mom jeans into lowriders again.
Right.
You can't do that, right? And so they're growth at all costs, now profitability.
Well,
and we've always had to be profitable.
Was it the owner of Rome that we talked about that kind of had investor money come in, and then kind of the business got away, and then he got back much more involved. Nate Checkett's more involved in it. So, well, when or whatever the next stage is.
Or just come back.
Just
come back.
In New York.
I mean, we might be a long-term business.
I
might be here for many, many years.
I think it's great, and I
Thank
would
you.
say your workers and your supply chain would appreciate that. No doubt about it. Good luck on this Valentine's Day.
Thank you. Thank you so much.
So appreciate
you having me.
Christina Stembel, founder and CEO of Farm Girl Flowers.
Hey, we're talking about continuing on this AI trend for our show today, Carol, because there's a lot of news. Apart from Palantir, which we spoke about just a few minutes ago, some other companies we want to highlight. NVIDIA and Cisco teaming up to make it easier for corporations to build their own AI computing infrastructure. It's an attempt to push the technology beyond those big data center providers.
All right, so let's get into it, because there's also a favorite stock that I always like to talk about, Supermicro Computer. Ian King is Bloomberg News U.S. semiconductor and networking reporter. He joins us on Zoom from San Francisco. Ian, there's so much going on, a million questions. We focus so much on artificial intelligence when we talk about the semi world. Are we overdoing it when we talk about the impact AI will have ultimately on the semiconductor chip industry?
Not if you believe the projections, no. I mean, Lisa Su, the CEO of AMD, one of the sort of more conservative and sober figures in the industry, has put out projections for AI accelerators. That's just one specific type of chip, that if they come true, the sort of 400 billion a year kind of target that she's put out there, that's going to be half of the entire industry. So again, if that's true, then it's kind of difficult to overstate the impact that we're seeing from this particular technology development on the industry.
Hey, one company that I want to talk about, because it really is Carol's favorite company to talk about,
a little bit,
is Supermicro Computer, Ian. Shares have more than doubled this year. It's only February, okay?
Yep.
Last year it surged about 250%. It's eclipsed the returns of other companies like NVIDIA, AMD, Microsoft, up 700% since the end of 2022. What are your thoughts on a name like this? It's not one that we talk a lot about.
Yeah, I mean, it's obviously a smaller company. It does something which is relatively prosaic, which is sort of equivalent to what a Dell or a HP Enterprise does, but on a kind of smaller scale, which is build the servers. The argument, though, and we've heard this from fund managers, is like, look, we know all about AMD, we know all about NVIDIA. If this AI thing is really going to spread and have this profound impact on the economy, we need to be looking at other companies that can gain from this as well, that haven't already basically topped out in terms of how much money we can put to work. And that, this is the kind of company then that you would kind of look at. What kind of marks them out, or has traditionally marked them out, is that they like to move towards new technology, new chips, new ways of doing things, cooling, all of these kind of things. They tend to be a little bit experimental, or at least have a reputation for doing that. So in theory, they would be sort of a prime mover in terms of jumping on any new innovation in this space. But I have to say that the idea of putting together servers is not particularly exciting for most people, or considered to be particularly high value.
Yeah, I love that. I just think it's interesting. And appreciate you weighing in on that. Having said that, I want you to weigh, or we would love for you to weigh in, Ian, on NVIDIA and Cisco teaming up to make it easier for corporations to build their own AI and computing infrastructure. They too are looking to push beyond the big data center providers. I understand everybody's trying to get kind of carve out their piece. I don't know. What do we need? What do we need to be smart about this story or kind of take away from it?
Yeah, I mean, there are a couple of underpinning currents here which I think are important. If our story, we did a chart of where NVIDIA's revenue comes from. 40% of that comes from the big guys, comes from Amazon, comes from Google, comes from Microsoft. What do those companies have in common? Obviously, they're cloud service providers. What other things do they have in common? They're all making their own chips, right? This is something that they did to combat their reliance on Intel back in the day, something that they're also acutely aware of. They don't want to transfer that dependence from Intel to NVIDIA. Right now, everybody needs NVIDIA, but clearly they're working to lessen that dependence, and that is a threat to NVIDIA's growth. Jensen Huang is not stupid, as we know, and he's definitely cognizant of this, and he's out there talking about if this AI trend or surge has legs, then it has to be the small to medium-sized companies or even the large corporations have to take advantage of this. Just at the country level as well, it has to be something that happens. These kind of organizations can't do it themselves. They don't have the PhDs that Google has. We can do it for them. Cisco can help us sell it.
God, it's just so much going on and a lot of energy in the space right now. Hey, Ian, thank you so much. So appreciate it. Ian King, U.S. semiconductor and networking reporter at Bloomberg News. Check out his story, too, on the terminal about the world's chip industry poised to bounce back again after a tough 2023. It's at Bloomberg.com or on the Bloomberg.
It's 3:21 on Wall Street from Bloomberg World Headquarters. I'm Charlie Pellet, developing story. The headline right now on the Bloomberg Professional Service, Starbucks Workers United has announced the filing of 47 new federal unfair labor practice charges against Starbucks. Starbucks shares right now are advancing. They're up by 2.9%. An update now for the U.S. stock market with the S&P higher by 3 points. Little change, but higher by 0.1%. Dow Jones Industrial Average up right now by 62 points. That is a gain of 0.2%. NASDAQ lower by 10, a drop of 0.1%. 10-year at 4.08% with a 2-year 4.40%. Spot gold up 11.30 right now, up by about $11.50 the ounce, up by 0.6%, 20.36. And West Texas Intermediate crude up 1%, 73.51 a barrel. Again, the 10-year 4.08%. As for the rate cut outlook, Deborah Cunningham is Chief Investment Officer at Federated Investment Management.
It seems like the stage is set for the Fed to have a slow decline in rates. Nothing that's precipitous, nothing that's, sort of meeting after meeting, starting in the spring of this year. We're really of the opinion it's a second half event.
And you can hear more of the conversation with Deborah Cunningham on the Surveillance Podcast. You can download it wherever you get your podcasts. J.P. Morgan Chase plans to open more than 500 new branches and hire 3,500 workers over the next 3 years, expanding into additional markets that include low-income and rural communities, as well as locations aimed at the rich. Recapping, stocks are trading mixed. We've got NASDAQ lower. However, the Dow, the S&P, they're both higher. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Really do appreciate it. Well, it's time for another edition of Bloomberg Plugged In. It's your weekly look at EVs. And joining us is Ed Ludlow. He's the co-host of Bloomberg Technology on Bloomberg TV. He joins us from our San Francisco bureau. Ed, so what's top of mind for us, of course, is Ford earnings. The company reporting after the bell today. It's been a bumpy few months, to say the least, with that transition to EVs, reducing production of the F-150 Lightning plug-in by half. Ford's EV sales in January fell 11%, including a 51% drop for the Mustang Mach-E. Is it just a return to basics? Is it a return to the internal combustion engine for the area of growth for Ford, Ed?
It's not a full return, but it's a kind of rebalancing back to that core legacy business. That those numbers are pretty alarming, right? 11% overall drop-off in EV sales in the quarter gone, and 57% drop in Mach-E in particular. There was some sustained strength in the Lightning pickup. But they're losing a lot of money making EVs, and they're making money on their legacy combustion engine cars, particularly higher-end spec pickup trucks and SUVs. And so the Wall Street's basically saying, we know that this is the situation you're in right now. How are you going to stop the losses in the near term? And they've rebalanced their operations and workforce to reflect that rebalance in demand.
All right. So top of mind is certainly kind of this continues to be, I feel like, for everybody who's a global auto manufacturer, but it's the EV rebalance. But they're also going to have to play around with, right, the impact of their new contract with the UAW, right? That's another thing that is kind of coming at them for a double whammy.
Yeah, and for that, you basically go to the old school fundamentals. What do they see as their outlook for profit in this year? Because what they've talked about is that the value of that UAW contract makes each of their vehicles more expensive by around $900. Somebody has to eat that cost. Either the OEM eats it on the bottom line, or they charge the consumer more. And that links right back to the EV story. We're forecasting 9% growth in EV sales in this country this year. There's still growth. It's slower. But this high rate environment that we're in, the cost of financing and the already elevated price of EVs, that's what is putting the consumer off. So if the UAW is materializing in another $900 per vehicle cost, that's something that Ford has to take into account if they want to continue to sell cars at volume.
Ed, I remember a couple years ago, Ford made this big move. They split the business into a couple different companies, or not companies, excuse me, segments, Ford E and Ford Blue. I remember you talking to us about that story.
Yes.
Look back on that for now and tell us, like, in hindsight, if there are analysts now questioning whether that was the right move.
Yeah, I reflect on that because Keith Norton and I broke that story quite a few months before they actually did it. And of course, at the time, Ford denied that it was true. And it was 100% true. And the problem is that the initial part of their story with Ford Model E, which is the electric vehicle unit, and everything that went with that, the charging infrastructure play, the software play, it takes a real long time to make money until you're producing at volume. And the key point of difference that Ford had against Tesla is they were transitioning a business from a legacy combustion engine business. They needed to keep that legacy business going to fund the future. The problem was that the amount of money that they were losing on EVs outpaced the amount of money they could make from that legacy business. Tesla doesn't have that issue, right? It's just an EV name. It doesn't have to phase out a legacy business. And the problem that Ford had is the timing. What's happened in the last 12 to 18 months in the time that's played out is high inflation and rates being where they are, and that has changed the end market picture for the consumer as well.
I feel like this is going to be interesting in that, Ed, Ford has put so much out there, right, about their worries, their concerns, how the business is being impacted. So I'm trying to think about, as the headlines cross after the close today, and we're breaking them down and we're going to do some analysis, what is it that could be even more of a surprise since they have given us so much, I feel like, already?
Yeah, I guess that we think about the outlook, right? Because General Motors set us up for such an incredible year. General Motors told us that on an EBIT basis, they would make $12 to $14 billion this year, which if your main story is not going well, the EV thing isn't going well for you, if you can turn around and say to investors, but don't worry, guys, we're going to make a lot of money this year, then it kind of appeases somewhat the concern the street might have. And I suspect Ford might do something similar.
That's interesting. Why? So how would Ford go about doing that?
Well, they would give us an outlook and a forecast for EBIT or profit, and we would decide whether or not the financial health of this company is rosy based on strong sales of high-priced combustion engine cars, but also how does the EV story factor into that? How much of the confidence in their outlook is based on the fears of an EV slowdown are overdone? They have pulled back production. Remember that your ability to supply has to meet demand, and we know that they will cut their ambition for EV this year by about 50%. But if that demand picture changes, they can always boost supply again. So some detail about this year would be really important when it comes to what consumer demand actually is for electric vehicles right now.
So, Ed, is there a way that Ford is sort of future-proofing the business right now, in a sense, making it more nimble to respond kind of more quickly or as quickly as you can when you're talking about autos? You have to plan out pretty far ahead of time because they have these two different segments and because they are able to increase production of one line versus another.
They have these two segments, but within the EV business, they only have three models. The F-150 Lightning, the Mach-E, and the Transit van on the commercial side. And what's been really interesting in the last 2 weeks, while this big story is built around slowdown in growth of EV sales, is that consumers need much more choice. There are very few battery electric models on the market at different price points to encourage the everyday American to buy an EV. And Ford's not really contributing to that. They just have two consumer models. And there's this building academic debate that the more models that come online, that might be the next wave that unlocks some new demand, things that match the price point and category that the specific consumer is looking for.
Yeah, and I do wonder, if they're kind of getting a lot of the worries, the concerns kind of out ahead of this, kind of a reset. I do feel like, I don't know, Ed, I don't know how you feel it in your world, but I feel like we have interview over and over again, whether it's about the markets or about running different businesses. It's like we're finally getting back to normal. And, the global auto industry has to deal with not only coming off a pandemic, which just turned everything upside down, but also an industry that is going through an upheaval as we move away towards EVs. There's a lot going on.
The reason I love this show is because there is a visual element to it. So if you're watching, look at the shape of my hand. We went like this with EV, and then we went like this. And for those listening, I drew an S-curve. And the point is that we had compound growth of 65% in the last 3 years for EV sales. This year, we're expecting 9% growth. The rate's just dropping off. And there are so many factors behind that, some economic, some on the supply side, and a lack of models, as I said. But specific to Ford, where it sits within that, is this transition period that it's in, still relying on its legacy combustion engine as the cash cow that funds the change. That's a really hard spot to be in.
Yep.
How's that different than where GM is, just in the last 30 seconds that we have with you, Ed?
Well, GM slightly more models coming. They probably had to pull back slightly less than Ford did because Ford really went for it, I guess, in how they divided up that business. But still suffering from the same issues, both of them.
All right, so let's see if Ford can ultimately put out some kind of outlook like GM did, as you said. All right, guys, we know there's worries, but look what we can do. We'll see whether or not we get that.
Hey, we'll find out pretty
from
soon.
Ford. Yeah, just less than an hour or so. Ed Ludlow, love you when you can do S curves or whatever. It's just kind of wonderful. Thank you so much. Really appreciate it. All right, our Ed Ludlow, co-host of Bloomberg Technology at Bloomberg Television, I should say, joining us from our San Francisco bureau. So Ford, we'll be watching after the close, but it is interesting, as he said, like whether or not we'll get some kind of outlook. I'm looking at Ford shares right now.
Yeah, that's what I was doing too.
What are they doing?
Up 3.7% right now.
That's a rally.
The S&P is flat.
That's a rally. That is what we would call, folks, on this Tuesday, some outperformance.
Hey, let's get a check on the latest world and national news. We got Nancy Lyons in the Bloomberg 99.1 Newsroom in D.C. Hey, Nance.
Hey, Tim. President Biden today made a last-ditch appeal to Congress to enact the bipartisan Senate compromise that strengthens border controls and provides aid to Ukraine and Israel. Bloomberg's Irv Chapman has the update from Washington.
The president conceded that even passage in the Senate is increasingly unlikely.
Why? Because Donald Trump thinks it's bad for him politically. He'd rather weaponize this issue than actually solve it. So for the last 24 hours, he's done nothing, I'm told, but reach out to Republicans in the House and the Senate and try to intimidate them to vote against his proposal.
Lost.
And looks like they're caving.
The president said Ukraine is in dire straits right now, and if the bill fails, he'll take up the issue of its obstruction as he campaigns all over the country. In Washington, Irv Chapman, Bloomberg Radio.
Donald Trump does not have presidential immunity from prosecution on charges related to his alleged efforts to overturn the 2020 election. That's the ruling today from a federal appeals court. Trump's legal team argues that he is immune from prosecution because the charges relate to official acts performed while he was president. Trump has until Monday to file an appeal. Secretary of State Antony Blinken is in the Middle East trying to negotiate another ceasefire in the Israel-Hamas war. He says it is looking possible.
Hamas responded tonight. We're reviewing that response now, and I'll be discussing it with the government of Israel tomorrow. There's still a lot of work to be done, but we continue to believe that an agreement is possible and indeed essential.
The deal Blinken is referring to would include the release of some of the hostages. Just today, the New York Times reported on an Israeli military internal assessment that a fifth of the remaining 136 hostages have not survived. That's higher than previous numbers. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
It's 3:40 on Wall Street from Bloomberg World Headquarters. I'm Charlie Pellet. Stocks are trading mixed. 20 minutes to go until that closing bell clangs on Wall Street. We've got the Dow higher. Right now, NASDAQ is in the red. S&P, let's call it unchanged as we head right over to the First Word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks mixed in a choppy session with the Dow currently higher by 56 points. S&P's, like you said, little changed, and NASDAQ is lower by 38. The U.S. 10-year yield at 4.08%. Gold is up 11. Oil trading in the green, and Bitcoin is higher by 1.9%. Among the main 11 S&P sectors, leaders were materials and real estate. Only tech and telecom were in the red. And leaders to the upside in the Dow, Walgreens and Nike, while Amgen and Salesforce led to the downside. After earnings, GE Healthcare rose 11%. And in deal news, Kohl's is being pushed by Vision One Management to explore a sale. In other news, New York Community Bank Corp fell as much as 26%. And wrapping things up, some of the names reporting after the bell tonight include Ford, Prudential, Amgen, and Chipotle. Live from the First Breaking News Desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg, type Squawk, SQUA, on your Bloomberg terminal. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
The funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just 18 minutes left in today's trading session. It is time for the drive to the close. You know, speaking of driving crazy, I think what really drives us crazy in 2024 so far, Tim, this year, is not necessarily what's going on the equity side of things, but it's the Treasury trade. I mean, here we are.
Why is it driving you crazy?
Well, you know, we're back, we're at 440 on that 2-year note. We've moved down a little bit, but the last 2 days have just been wild.
How's that 10-year looking?
10-year, we're looking at 408. So we're staying above that 4% mark.
Yeah, yesterday was 4.15.
We've been higher, right? And our own Mike McKenzie was talking about going at 4.25 on that 10-year.
Yeah, he's got folks he knows the folks who are ready to buy when it hits. If it hits 4.25 this cycle.
And is that ultimately the peak when it comes to the 10-year? All right, lots to get to, not just treasuries, but obviously important, but also on the equity side of things, really how investors are thinking in general about the investment environment. Let's get to it with Liz Young. She's head of investment strategy at SoFi. She joins us on Zoom in New York City. Hey, Liz, good to be talking with you again. How are you, and how do you think about this environment? What is kind of top of mind when you think about investing right now?
Yeah, well, thank you for having me. Good to be back. One of the things that I think is happening right now is, you know, we spent most of 2023 looking around the corner for a recession that didn't happen. And now in 2024, it seems like the market is declaring that it's never coming. And I don't think that either of them will prove to be correct. Obviously, we were already wrong about 2023 having a recession. For 2024, the idea of we've already accomplished it and we have the soft landing, it's occurring. I don't think that that's going to end up necessarily being the case, although today that is how it feels and that is what the data is suggesting. But the idea of the business cycle not really being over yet because we haven't started cutting rates. We've just had the hiking cycle and we're still seeing a lot of late cycle behavior in the markets. I just don't want investors to declare premature victory on a soft landing and be caught flat-footed.
Well, one really smart sign of how investors feel about whether or not we've got victory is what's been going on with money markets. And I think about the headline we got on February 1st, money market fund assets reached $6 trillion for the first time. That's a very clear signal from the investing community about kind of how they feel about taking on risk. What are you seeing on the SoFi platform that shows the tolerance, the risk tolerance among investors?
Well, you know what's interesting about the money market trade is that you can sort of slice it two different ways. You could say, in a very straightforward sense, money's going into money markets, that must mean people are scared. When I really think it's more about a rational investment decision. So if you're going to be able to get 5% in a money market, and I'll throw things like short-term treasuries into that too. If you can clip a 5.2% coupon on a 6-month treasury, why not, right? That's a rational investment decision. So while rates are still in this range. And as we've seen, you talked about at the beginning of the show, as we've seen the 10-year stay above 4% now, there's a lot of volatility, but it's still pretty high. So money markets aren't necessarily right now sending the signal, to me at least, that people are scared. I think they're sending the signal that people are trying to make money in income generating assets. And as rates fall, whenever the Fed starts cutting, that's when money markets start to become less attractive. But that'll be the telltale sign, is if people take money out of money markets and put it into other income generating assets, or if they take it out of money markets and put it into really risky assets or growthy stocks in the S&P 500, for example.
What do you think happens to those money market funds?
Well, to be honest, I mean, I'm surprised that it continues to rise. I'm surprised that the balances continue to rise, because I don't think that they've necessarily got more attractive since the end of last year. But if we continue on this path where the soft landing looks evident in the sense of, okay, the labor market hasn't cracked, inflation has come down. If we were on a path where the Fed was going to start cutting rates in March and this data still seemed good, that's where I think money market funds lose some assets and it goes into risky assets, because that would be supportive in that environment. That has changed. We have now all but priced out a cut in March and expecting a cut maybe in June, maybe it's May, but it continues to get pushed further and further out into the future. So I think the longer the market expects the Fed to wait, the more nervous people will get about them waiting too long to start the cutting cycle, in which case, if and when money does come out of money market funds, it stays in some other safe haven asset.
What other safe haven, though, would you expect it might go if people are really nervous?
Gold. I think gold, it's obviously seen quite a big run, but if people are worried about the value of the dollar, if you see rates come down very quickly and the value of the dollar come down very quickly, you want something that's a store of value, and gold continues to be that option. I think you might also see money still flow into treasuries, and you might see money flow into longer term treasuries if people start to get worried about the data. You might also see things like the really defensive parts of the stock market. Utilities has lagged quite a bit this year. You might see utilities catch a bid. Consumer staples has seen some of that, and even parts of healthcare if people aren't quite ready to completely get out of the stock market.
I feel like the world would have to be coming undone if everybody was running to the exits and throwing stuff into gold or even utilities, right? Like, I just feel like it would have to be pretty dire. Is that fair? I mean, Liz, is that how you would see it? I don't know.
Well, it doesn't have to necessarily be a rush, right? It could happen just in sort of a slow fashion where people are slowly taking money out of something that isn't quite yielding what it used to yield and putting it into something else, but they're not ready to go all in on the risk table. So I don't think it necessarily has to be a big flood. I do agree that in order to see some huge rush to the exits out of the equity market, especially after a time where momentum seems to be pretty strong and there's clearly buying appetite out there, you would need a catastrophic sort of data print or a few months in a row where things went bad, or you would need some kind of headline. Now, of course, that's always a risk. That continues to be a risk, but I don't think we've solved all of the problem. And we have question marks about a lot of things still remaining.
Hey, Liz, we're seeing shares of Palantir up by 30% right now. We were reminded by our own Mandeep Singh a little earlier that Palantir was a meme stock, and I'm wondering if you're seeing any sort of meme stock behavior on the SoFi platform that reminds you of where things were in 2020, 2021.
I don't think we're at that point. I think, obviously the market has seen a handful of stocks really lead the way. And it's interesting that the Magnificent Seven has now become sort of the Magnificent Four, and we've got a new stock in the mix. So it continues to narrow. And it's just the idea, not necessarily, I wouldn't call it meme stocky, but the idea that you've seen double-digit moves in some of these names over really short periods of time. And some of those moves have happened over a month. Some of those moves happened over a 2 trading day period. When you see moves that big on news that maybe doesn't justify a move that big, it starts to feel like excessive risk taking.
Yeah.
And the thing about that, though, is momentum is strong. It'll continue until it stops. And if you can call that time, good for you, but most people can't.
We know the rules, or what everyone has always said about market timing. Hey, Liz, thanks so much. Be well. Liz Young, she's head of investment strategy at SoFi, joining us on Zoom in New York City. Folks, we've got just about 10 minutes to go before we ring the closing bell on Wall Street. This is Bloomberg.
your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. Word of more job cuts at Amazon. Amazon.com laying off hundreds of employees in its healthcare division, stepping up an ongoing campaign to trim costs. Neil Lindsay, chief of Amazon Health Services, said in a note to employees the job cuts will impact a few hundred roles between the one medical chain of doctors' offices that Amazon acquired last year and the company's online pharmacy operation. Amazon shares right now down by 0.9%. Hertz Global Holdings missed analyst estimates in the fourth quarter as it sold down its fleet of Tesla electric vehicles, citing high repair costs and a drop in residual value. Hertz shares, though, after earnings, they are advancing today by 8.3% right now. Tesla shares, they are down by 1.8%. Boeing's largest union, the International Association of Machinists and Aerospace Workers, will be demanding a 40% pay raise over 3 or 4 years, emboldened by a resurgent labor movement and a scarcity of qualified aerospace workers. George Ferguson follows the aerospace industry for Bloomberg News.
In lots of other manufacturing, you do higher volumes, and you do a lot more templating. You do a lot more. You'll buy a lot more capital tools that will help make up for perhaps any deficiencies in the workforce. There's a lot of manual labor that isn't capital tool accompanied in this business, and so you need smart people, well-trained people on the line, focused on detail, and it's hard to do. They're going to probably get a pretty nice pay package.
And that's George Ferguson with Bloomberg Intelligence. Today we're looking at Boeing shares. They are moving higher. We've got Boeing up now by 1%. Those are our top company stories at this hour. I'm Charlie Pelletin. This is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
It is Bloomberg Business Week, and February is Black History Month, and every day this month we are celebrating significant moments in U.S. Black history. Now with your installment for February 6th, here's Bloomberg's Justin Milliner.
Thank you very much, Tim. On this day in Black history in 1993, groundbreaking U.S. tennis player Arthur Ashe passed away at age 49. His life cut short due to AIDS. While his illness and passing was tragic, Ashe made sure he left a positive legacy. During his final years, he dedicated time to educating people about the illness, creating the Arthur Ashe Foundation for the Defeat of AIDS. And on the court, Ashe was also an activist and a trailblazer, to say the least. He was the first black tennis pro to win singles titles in Wimbledon, in the U.S. and Australian Opens. After his playing time was done, he involved himself in a lot of projects that helped future players. Ashe played a significant role in helping get the stadium that would eventually bear his name built. Today, Arthur Ashe Stadium is home to the U.S. Open and has played host to some of the sport's most exciting moments, ensuring that Ashe's name would forever be linked to greatness. And that is today in Black history.
Yeah,
Tim.
It's an incredible story. We think about it when we're over there at the U.S. Open doing live remotes, but it's just incredible, not only what he achieved personally, but what he did to really help others and pave the way for others. It's just incredible.
At each step in his career, too. I mean, an AIDS diagnosis is absolutely catastrophic.
Devastating.
But he didn't, hide himself away, especially during that time.
Mm-hmm.
He actually took that and, was an activist. He found ways to help other people and was very public with it, when in theory that's a very private thing. He didn't have to do that, but it falls in line with how he lived his entire life.
And what's amazing is his legacy on tennis, on the USTA. Carol and I broadcast each year from the US Open, and we do it in the shadow of Arthur Ashe Stadium. And every year we talk about his legacy, and people who come on from the USTA talk about how important and instrumental he was in bringing tennis, keeping tennis in New York, bringing the stadium to Flushing Meadows, and also what he did throughout the country to raise the profile of tennis. I mean, his incredible legacy.
Yeah, exactly. What he did was just so remarkable. But I also agree what you said in terms of AIDS, when there was such a stereotypical kind of thinking about it, fear about it, and then to have him be out there front and center just was so important, really, to society at large. Justin, thank you so much. Great stuff. Justin Milliner. All right, guys, we're just counting you down to the close. We're heading over to our TV team because Beyond the Bell starts right now.
last 20 minutes is pretty much a straight line higher, but volume is still very, very light at this point. The S&P 500 closing up 0.25%, 49.54, just below that 5,000 level. Dow Industrial is gaining 1/3 of 1%. The Nasdaq, little change on the day. Let's round it up to 1/10 of 1%. And the Russell 2000 gaining 0.9 of 1%, the outperformer of the bunch.
Yeah, and a little bit of buying right here in the close. Having said that, you're looking at what most of the names in the S&P 500 higher today. 351 to the upside, guys, 150 to the downside, and Scarlett to unchanged.
All right, let's look at the sectors. Our IMAP, which really showcases the different sectors in the S&P 500. There's not a lot of red. The red really is in tech, which is down 0.5 of 1%, and communication services losing 0.2 of 1%. That's why it's so sizable on that chart. But overall, in terms of gainers, materials gaining 1.7%, REITs up 1.5%, and healthcare also gaining at least 1%.
All right, guys, let's get to some of the individual gainers, if I may. GE Healthcare, go figure. It is top in the S&P 500 and the Nasdaq 100. Biggest intraday gain in more than a year. Of course, the former member included in General Electric. It was spun off, as we all know. It's now a medical technology company exclusively. Earnings and sales for the fourth quarter beat estimates, and that Scarlett with Citi calling it better than expected. This name up almost 12% here.
All right, let me just jump in really quickly because MicroStrategy has reported results, and the fourth quarter revenue misses analyst estimates, down 6% to 124 million. Analysts were expecting 133 million. This is a company that really is just a way to play Bitcoin, given its strategy now. Michael Saylor has basically decided to bet the enterprise software maker's future entirely on Bitcoin. So the stock off by 2.6% as, again, the fourth quarter revenue misses the average analyst estimate.
Okay, so some other highlights from the report. The company now holds 190,000 Bitcoin. They acquired 31,755 Bitcoin since the end of Q3. They paid $1.25 billion for that, or $39,411 per Bitcoin. 190,000 Bitcoin at a total cost of $5.93 billion. So that average price of $31,224 per Bitcoin. That's as of February 5th, 2024. Talking about the important stuff here, Scarlett.
Yeah, let's go to important stuff too. Let's go to Gilead and Amgen. So Gilead just coming out right now. You have revenue for the fourth quarter coming like bang in line with estimates. Their forecast for this year also maybe a little bit light on the low end, but high on the high end, so 27.5 billion. If you take a look for some of their most important drugs, Trodelvy, we're waiting to see what's going to happen there because that failed to keep patients alive longer in the lung cancer trial. But overall, it does see earnings for this year and revenue this year. It appears in the high end to be a little bit better than estimated, guys.
All right, so let's get to Amgen, also reporting, as you mentioned, Alex. Amgen, let's go to the outlook. Sees 2024 revenue, folks, of 32.4 billion to 33.8 billion. The estimate out there is 32.51 billion. So it does sound like it's kind of moving up the higher end, if you will, or the upper end. Fourth quarter revenue, going back to the fourth quarter, 8.2 billion. That's a beat. 8.12 billion was the estimate among analysts out there on the street. Fourth quarter adjusted EPS, $4.71 a share. That's 11 cents better than what the street was expecting. And also looking at fourth quarter adjusted operating income of 3.66 billion, and bang, that was in line with what the street was expecting.
And the important thing to remember with Amgen is that it is now a player, or wants to be a player, in the obesity drug market, right? Because of its purchase of Horizon Therapeutics over the past year in October. It closed in October. $27.8 billion purchase, and as a result, Amgen is looking for revenue to jump as much as 20% this year, thanks to its seemingly bottomless demand for these treatments.
Just going through the press release, looking for some color. Amgen shares up by just about 0.5 percentage point right now. The company's CEO saying that 2023 was another year of performance and progress for our company. Our marketed products are reaching many more patients around the world, and we anticipate more than a dozen significant pipeline milestones in 2024, Alex.
Yep, and we're still waiting for other earnings as well. VF Corp, so good look on the retailers. We're going to be getting that. We're also waiting for Ford, so looking out there as well. And just to reiterate, when it comes to Gilead, let me go back to here. They're looking at about their 2024 earnings as well as revenue and sales kind of bumped up on the higher end versus estimates. So very similar to what Carol was talking about when it comes to Amgen.
Yeah, I'm looking at Amgen, right, which is up already about 10% this year. And as you guys said, we're not seeing a ton of movement in the after hours. Just going back to it, now it's just down, Scarlett, about 0.5% here.
Yeah, I'm looking ahead to Ford. I'm really excited to see what the company says with regards to EVs, because we know that the big legacy car makers, GM, Ford, they've really had to scale back a lot of their ambitions as Tesla and the other EV makers continue to cut costs. And look, the numbers just crossed. It's like we wished it to happen.
Nice
All right,
job.
let's talk about Ford here. Fourth quarter, where should we start?
Go to the outlook, maybe?
Yeah, let's go to 2024. Ford Model E EBIT loss. Okay, that's the electric vehicle. $5 billion to $5.5 billion. 2024 adjusted EBIT of $10 billion to $12 billion. Analysts were looking for $9.25 billion.
Yeah, I'm looking at the, it's a slew of numbers here. Adjusted EPS coming in above estimates too, 29 cents versus estimates of 13 cents. Shares were higher by about 4% today in the after hours. Shares higher now by 2.6%.
I'm going to say this outlook is really important. Sees 2024 adjusted EBIT of 10 to 12 billion. The estimate was 9.24. Remember, General Motors came out and they kind of set it up. They put out an adjusted EBIT for 2024 of about 12 to 14 billion, and that beat that estimate that was on the street of about 10.96. So in other words, they set the bar high, saying, yep, we're having troubles with EV. We understand there's been kind of a readjustment, but look at what we are doing in terms of the overall outlook as we kind of shift our product mix. And basically, our Ed Ludlow we talked to said, let's see if we get Ford to give an outlook similar to what we got from GM that is upbeat, and that's essentially what we got. And you've got Ford up about 6.2% here in the aftermarket.
And if you don't like those numbers, then they'll be like, look at this shiny thing over here, and that's a first quarter supplemental dividend of 18 cents a share. So you may not like where we are in the mix, you may not like where we are in terms of reallocating money and workers, and we may not like our margins when it comes to our EVs, but we have this nice little supplementary dividend of 18 cents a share.
Yeah, it buys us some time as we try to reconfigure everything. Meta did it. I mean, Meta's numbers were blowout, obviously, but overall, there's a big transition taking place at the company, and that dividend widens the shareholder base, certainly. I mean, Ford doesn't have that issue because, of course, its shareholder base is there, and a supplemental dividend, does that mean it's a one-time thing, and it's not going to build off of that?
Extra juicing?
Yeah.
I'm interested to hear how Ford positions itself right now, given that it's made this pivot away from electric vehicles, or de-emphasizing electric vehicles. De-emphasizing, given the struggle that it's had in recent months when it comes to the Mach-E and the F-150 Lightning. Here's what Jim Farley, the CEO, said in the press release. He said, he's talking about consumer choice. He said, we're the only company that gives customers such a wide range of choices, gas, hybrid, and EVs made possible by our Ford Plus plan and the talented team that's carrying it out. Ford is creating a product, software, and services powerhouse with huge potential for this year and the long haul.
Yeah, also in the press release, we're saying they've got a quote, EVs are here to stay. Customer adoption is growing and their long-term upside is central to Ford. So this is also coming from the C-suite in Ford. So anyway, the stock definitely off and running with that outlook. So you're looking at what? Ford up about 8.2% here in the aftermarket.
Thank you, shiny bright thing of supplemental dividend.
Thank you, supplementary dividend.
But also, guys, they gave an outlook that despite all the nervousness and concerns, they're like, we got some good numbers, better than what the street was expecting.
They did. They definitely managed expectations well.
All right. Is that a little skepticism? All right, guys, that's a wrap. Our cross-platform coverage on radio, TV, YouTube, and Bloomberg Originals. We call it Beyond the Bell. We'll see you again, same time, same place tomorrow.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
All right, we've got a new stock on our mind on this Tuesday, February 6th, and that's Ford. Ford shares off their highs in the aftermarket, but still up about 7.3%. This as the company beats profit expectations, sees more earnings growth ahead. And listen, they gave an outlook, right? They didn't say we're backing off of it. They gave it, and it was well above what the street was expecting.
Yeah, $10 to $12 billion before interest and taxes. That compares with $10.4 billion on that basis in 2023. The result was on the high end of the $10 to $10.5 billion that the company predicted back in November. That, Carol, was when it lowered guidance following a 6-week strike by the UAW.
All right, let's see what Ivan Feinseth has to say. He's senior partner and CIO over at Tigris Financial Partners. He's on Zoom in New York City. All right, what say you, Ivan, in terms of what we just got from Ford? Because investors certainly like it in the aftermarket here. Stock's still up about 7%.
Well, we got a lot of positive macro trends for the auto industry. One, jobs, jobs, jobs. The job numbers continue to be great, which means people are working, and when you're working, you need a car to commute to work, and you have money to buy a car. Number two, we still have a significant pent-up demand cycle that has come from both the recent UAW strike and the shutdown in production that we experienced during the pandemic that the industry really has not yet to recover from, but is ramping up production. So you got strong demand, you got consumers able to buy cars, and you got GM and Ford both have a significant cash cow, in their truck business, which are the best-selling vehicles that they make.
Strong demand for what, though? Strong demand for internal combustion engine vehicles like the classic F-150, like the Ford Bronco,
Yes.
or demand for EVs?
The Ford Bronco still very strong, the F-150. And while consumers and the industry does want to make the transition to EV, unfortunately, we need this middle stepping stone of the hybrid cars that are both, gas EV powered as the nationwide charging network ramps up.
Ivan, hang on for a second. Just a headline crossing. Shares of Snap are down about 19-20% here.
What?
In the aftermarket.
Oh, man, this company's being crushed.
The company coming out with an update saying it sees first quarter revenue 1.1 billion to 1.14 billion. The estimate on the street is 1.11 billion. Sees a first quarter adjusted EBITDA loss of 55 to 95 million, much more than what the street has been thinking about. The estimate loss of 32.7 million. Also talking about fourth quarter daily active users, 414 million versus an estimate of 411.59 million. So that's a little bit better than forecast. But that outlook and really that first quarter adjusted EBITDA loss has got to be worrying investors.
Yeah, what's interesting, though, is it beat on the fourth quarter adjusted EBITDA significantly, 159.1 million versus estimates of 111.
But it's the
looking
outlook.
Forward, I know.
It's like, what have you done for me lately?
And I think the question is, what is Snap doing, or what is Meta Platforms doing that Snap isn't doing? Because these two stocks certainly diverging.
All right, Snap shares down about 20% in the aftermarket. They were up just slightly on the year. All right, from Snap back to Ford we go, because Ford up about 6.5%. In the aftermarket following their earnings and an upbeat outlook and also a dividend. This first quarter supplemental dividend of 18 cents a share. We were talking about that with some of our colleagues. Is this a one-time thing? Is it just to kind of appease investors until they kind of get the product mix right?
Well, I think that both GM and Ford have announced significant amounts of returning of cash to shareholders, driven by the tremendous cash flow that they have from their ICE and truck vehicle business. And that, again, shows the strength of their cash flow and the confidence in their cash flow. And as they have enough capital to both return money to shareholders and continue to invest in their EV transition.
I will say, looking at the press release, they talk operating cash flow 14.9 billion for all of 2023. They say solid adjusted free cash flow of 6.8 billion was significantly better than the company's outlook of 5 to 5.5 billion. Ford's balance sheet remains strong with nearly 29 billion in cash and more than 46 billion in liquidity at the end of the year. I'm reading just straight, Tim, from Ford's press release.
Hey, Ivan, do we get to the point in your opinion where in any time in the next few years we're going to see the same number of EVs sold as ICE vehicles sold by a company like Ford?
Well, both Ford and GM had predicted that more than half of their auto production by 2025, the end of 2025, would be EV. They both kind of walked this back, but we have both the auto industry trying to move forward to increasing the mix of EVs to 50% and eventually 100%, and then bumping up against government mandates that in many cases by 2035, they will only be able to sell EVs. And both Ford and GM had kind of projected that they wanted to get to that level before by 2030, which both are not that far off. So you have the industry wanting to move in that direction. In theory, consumers want to move in that direction, and the companies want to move in that direction.
Yeah, they talk about Ford Model E's wholesale and revenue are both up at double-digit full-year rates. They also say by the end of 2024, 60% of Ford Blue's global vehicle lineup will have been recently refreshed. And they also talk about hybrids. And they said they sold about 700,000 hybrids worldwide over the past 3 years. We're expecting double-digit hybrid growth again in 2024. Ivan, we've talked about this on air, that in terms of the automakers, they're just kind of adjusting. Maybe they're not giving up on EVs. It's just the timetable maybe is changing. And then they're just kind of addressing the product mix that their consumers want. And it looks like they are being rather flexible, and that's a good thing that they can do that. Is that fair?
Yes. And I think maybe that both Ford and GM were overly aggressive in their schedule to make the transition to EVs, and both the market, consumers, and the industry in general is not ready for full EV, so they're going to have to increase. And even Mary Barra on her conference call last week said that they are going to ramp up hybrid production as to help with the transition. So ideally, I think that really will meet a lot of demand, because consumers want to go electric, but they're not ready to go all electric. And the charging infrastructure is not there to support an all-electric auto industry.
What do automakers need to do? What does the U.S. government need to do for the charging infrastructure to get there? I mean, we have gas stations on pretty much every corner in the U.S. That's taken generations to build up. What do they need to do to have the same thing for EVs?
Well, we need three things. Is one, the availability of the charging network, the availability of chargers, and more important, the availability of high-speed chargers, and the technology on board the vehicle to charge faster and for the charge to last longer. And over time, you'll see the batteries will, go farther on a charge. You'll be able to at least get, an interim charge. In many cases, they're talking on a 300-mile battery, 100 miles within, 20 minutes. And you're going to see this network of gas stations, I believe, eventually evolve to a place where you can charge and then spend a little bit more time than the 5 minutes it takes to buy a tank of gas. You're going to need, 15, 20 minutes to charge your vehicle. That's why a lot of the gas stations have restaurants and convenience stores and places to sit. So all this is going to come together. I believe that you see a lot of new gas stations being built with convenience stores and more consumer services within them.
They're going to become like airports. I can see it. That's where it's going. All right, Ivan, always appreciate it. Ivan Feinseth, Senior Partner and Chief Investment Officer over at Tigris Financial Partners. Ford shares still up about 7% there. In the aftermarket, this as the company beats profit expectations, sees more earnings growth ahead, and gives an upbeat outlook in terms of 2024 adjusted EBIT and also that dividend as well.
Hey, very briefly on Chipotle, fourth quarter adjusted EPS coming in above estimates. That is fourth quarter comp sales. Fourth quarter EPS 10.21 versus $8.02. That's up year over year. Hey, shares are up about 3% in the after hours.
Just got to mention Snap, folks. It is down 32% in the aftermarket. This as the company plunging after first quarter adjusted EBITDA outlook misses estimate. And so investors are sending it down in a big way. We're going to continue to track the earnings right here on Bloomberg Business Week.
From Bloomberg World Headquarters, I'm Charlie Pellet. 4:21, the time now on Wall Street. Earnings fast and furious, and we've got you covered. Snap shares, they are plunging now by 30%. Snap reported disappointing revenue in the holiday quarter as the company continues to reel from a slump in the digital advertising market. Again, after hours, we got Snap shares down now by 30%. Also reporting after the close of trading, Ford Motor, it posted fourth quarter numbers that soundly beat expectations, and it forecasts higher profits in 2024. Ford shares after hours, they are in the fast lane up 6.2%. Ivan Feinseth is a chief investment officer at Tigris Financial Partners, and he was a guest moments ago talking about Ford right here on Bloomberg Business Week.
Well, we got a lot of positive macro trends for the auto industry. One, jobs, jobs, jobs. The job numbers continue to be great, which means people are working, and when you're working, you need a car to commute to work, and you have money to buy a car. Number two, we still have a significant pent-up demand cycle that has come from both the recent UAW strike and the shutdown in production that we experienced during the pandemic that the industry really has not yet to recover from.
And again, we've got Ford shares pushing higher after hours, up now by about 6%. The Dow, the S&P, and NASDAQ turned a losing day into a winning day. We ended with gains for the Dow, right now up 141 points, up 0.4%. S&P at the close, higher by 11, up 0.2. NASDAQ, the composite index, also up 11 by 0.1%. 10-year yield, 4.08%. The 2-year, 4.39%. Spot gold up $10 the ounce, up 0.5%. West Texas Intermediate crude up by 1%. So again, recapping earnings after the bell, we did hear from Ford up 6.5%. Snap plunging after hours. We got Snap down now by about 30%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie Pellet. Check out the new Bloomberg Business app featuring Apple CarPlay and Android Auto. You can listen to Bloomberg Business Week and all of our Bloomberg radio programs at any time. Just download the Bloomberg Business app on your smartphone and connect your phone to your car. It's free in the Apple App Store or on Google Play. You'll get to hear a lot of Charlie Pellet.
Good stuff, good stuff. Always, always check it out and definitely access it. All right, when someone says AI, they can be referring to a lot of different things. You know that, right? They could be talking about chatbots such as ChatGPT or Google Bard, which are examples of LLMs or large language models. We talked about this a little bit with Mandeep earlier.
Exactly. Okay, what about when it comes to AGI, Artificial General Intelligence? It's the holy grail of AI. It's not around yet, but everyone is working on it. What that means is that AI can perform as well or better than humans on most tasks.
All right, so machine learning is something else. It's the focus of our next guest's new book. Eric Siegel is a consultant and former Columbia University professor. He's also the author of a new book. It is entitled The AI Playbook, Mastering the Rare Art of Machine Learning Deployment. It is out today. Eric joins us on Zoom from the Bay Area. Eric, congratulations. Let's start with the basics, because I think sometimes we all throw around phrases assuming everybody gets it, and they don't necessarily. How do you define machine learning?
Well, thanks, Carol. Machine learning is technology that learns from experience in order to make predictions, in order to target and improve large-scale operations. So who to target to for marketing based on predicting who's going to buy, which transaction to audit for fraud based on predicting which is going to turn out to be fraudulent, who to approve for credit application based on who's going to be the most reliable debtor, et cetera, which satellite to investigate for potentially running out of a battery based on whether it's going to, where to drill for oil. Pretty much this is the type of AI, and you could call it predictive AI or predictive analytics to differentiate it from generative AI. This is the type of AI you turn to when you want to improve pretty much any and all of your large-scale operations, which consist of many decisions, and prediction is the holy grail for improving decisions.
Would you consider the way that content is surfaced on a social media platform like X/Twitter or Instagram, would you consider that machine learning?
Oh, I see. Yeah. As far as the ordering of your feed,
yeah,
very
so
much
basically,
so.
like if I log in, if I start to follow someone new, like if I follow someone new on Instagram and then I log in Instagram again, like an old post from that person is going to be like the first thing that comes up because Instagram thinks I'm now interested in that.
Right, that's a prediction task, and the
Yeah.
same thing with the ordering of your Facebook feed, the default feed, assuming you leave it at that, and the same thing in the ordering of your Google search results. It's all based on predictive models. That's what machine learning generates from data, is a model that captures the patterns, that's the discoveries. It's made from data that helps it predict. Predict is the action. So you're predicting in order to say which of these content items is going to be of most interest or most relevant, whether it's for internet search, like with Google, or the ordering of your newsfeed, or the ordering of your search results for properties on Airbnb.
All right, whiteboard it for me. So AI, big umbrella, machine learning, a form of AI. Like how do we stack up and make sense in this environment of, because we do throw around AI, which has been around for a long time, but now we're talking about, generative AI. Give me the whiteboard on it. You're teaching a class. Like, how do you lay it all out in terms of AI, what it means, or machine learning, how it'll play a role?
Well, the typical hierarchy is that machine learning is part of AI, and that's a bigger umbrella term. But my opinion varies from a lot of the mainstream, although more people are jumping on board, that AI is really an amorphous, ill-defined term. We're trying to ascribe the word intelligence to a machine. That's quite problematic to nail down. But if you don't define something well, you can't pursue it for engineering. AI is the story we hear about. Machine learning is the technology that we have. And machine learning in all those ways I just described, where you're predicting for each individual customer, healthcare client, as far as their disease progression, or where to drill for oil, which satellite to investigate, and which transaction to audit. On that individual level, it's the same core technology that drives generative AI for its ability to generate first drafts of writing or code or of images. And in those cases, what it's doing is predicting what should the next word be. Okay, well, it's actually the next token, but it's on that level of detail. What should the next word be? How should I change this individual pixel in an iteration as I'm rendering this image, I being the computer in this case? It's the same core technology, learning from data to predict.
Have you, what's funny, Carol? So just a little behind the scenes, Eric, it's like we use this Google Doc to prepare the show, and we both work on it and work on different things, and Google now has predictive text. And when I was writing this one for Eric's intro, it actually got some stuff wrong, which I thought was really funny, because here we are talking about the technology that it's getting wrong when I'm like, writing a question in the doc. I mean, have you noticed that?
Yeah, no, you're absolutely right. You have to be very careful because it jumps ahead, right?
Yeah.
If you don't catch it. So yeah, how do we make sure all this stuff that it feels like increasingly moving towards relying on, make sure, whether it's machine learning, that it's accurate and predicting right things or the right outcomes or the smart outcomes? How do we make sure? I know, is it just the data sets that go into it? Is it that simple and that complicated?
No, I mean, no, because we're not headed with definitiveness towards reliability when it comes to that type of generated text. Look, these models are so seemingly human-like. They're amazing. I spent 6 years of my career in the natural language processing research group at Columbia, and I never thought I would see what we're seeing today. It's so amazing the way it creates often cohesive content. It can talk about anything, use expressions that humans use, and because it's trained over so much data and the actual modeling itself is so advanced. However, what it's trained to do is essentially on that per word level of detail, which really gives it a human-like aura, but that doesn't mean that it was developed to pursue higher order human goals like being correct. That's a whole nother thing. The fact that it's seemingly human-like doesn't mean it's a step towards general human behavior. So, you earlier, Tim, mentioned artificial general intelligence. I'm actually sort of a disbeliever in that. I don't think it's necessarily...
Why are you a disbeliever?
Yeah, I don't think it's technically impossible that someday, but I do not believe that any of the advancements, as impressive and valuable as they are, actually represent a concrete step towards general human level capabilities where the machine is basically, let's call it what it is. In the story, it's an artificial human. You can onboard them like an employee, like a human employee, and let it rip. They can run a Fortune 500 company, whatever it is. That is a science fiction fantasy. I do not believe that we're taking concrete steps in that direction.
So you're not concerned about the rise of the bots?
Right, and that's they call it crita hype, right? Where you say, hey, look, this stuff is so good, it could kill all of us. It's really just another way to sort of mismanage expectations. And there's a variety of reasons why people do that. Some some genuinely believe it. I'm trying to calm the world down a little bit here. The stuff is extremely valuable and in what it can do today. And the story that it's becoming human-like is it oversells. In other words, it's hype. And that gap between what's real and what's plausible from the stories is bad. And it's with mismanaged expectations, that's when you have the downfall, the disappointment, the disillusionment, also in the more extreme case called an AI winter. And the problem there is you throw the baby out with the bathwater. You throw the value of generative AI for first drafts and predictive AI, which, by the way, is still a much bigger industry right now, out with the bathwater.
You know, our producer, Paul Brennan, said, yep, you're going to want to talk to this guy for a long time. We have unfortunately run out of time, so promise you will come back soon, because I feel like this is a conversation we need to continue. Just making so much sense. Eric, thank you so much. Eric Siegel, he's a consultant, former Columbia University professor. He's got a new book out, The AI Playbook, Mastering the Rare Art of Machine Learning Deployment. We have a headline we want to bring everybody, and it has to do with Walt Disney's ESPN, Fox, and Warner Brothers Discovery. They're joining forces to launch a sports-focused streaming service that will feature major college and pro games.
Yeah, the service will be 1/3 owned by each company. Pricing and a name for the service have yet to be determined. Carol, it reminds me of the early days of what happened with Hulu. I'm talking way back in the day.
I totally agree. It's like, right, everybody competing on their own. They're like, wait, let's do this together.
This is like way ancient history here, like early to mid-2000s.
All right, lots going on. Let's get, though, a check on world and national news for you. Off to D.C. we go, and Nancy Lyons. Nance, take it away.
Thanks, Carol. President Biden is making an appeal to Congress. He wants lawmakers to pass the bipartisan border deal that includes foreign aid to Israel and Ukraine.
Bottom line is this bipartisan bill is a win for America because it makes important fixes to our broken immigration system. And it's the toughest, fairest law that's ever been proposed relative to the border.
Biden warned if Republicans fail to pass the bill, he'll make sure the country knows that they sided with Donald Trump, who opposes the bill, instead of with the American people who've been urging action along the border. A federal appeals panel in Washington has ruled against former President Trump and his legal team regarding the federal election interference case against him. The panel, in a unanimous ruling, said Trump can face prosecution and is not immune. Trump has been given until Monday to appeal today's ruling to the U.S. Supreme Court, but former Watergate prosecutor Nick Ackerman tells Bloomberg the High Court is not likely to take it up.
I think they would prefer not to be involved in this particular case. Don't forget, if Donald Trump is convicted in the D.C. case, he then will have the right to appeal the entire conviction to the Supreme Court and raise this issue at a later point.
Former Watergate prosecutor Nick Ackerman on Bloomberg's Balance of Power. Trump and his attorneys argue he was immune from facing criminal charges because he was president. A Michigan jury is out with the verdict for Jennifer Crumbley, the mother of school shooter Ethan Crumbley. She faced 4 involuntary manslaughter charges for allowing her troubled son to own a gun. Each verdict had the same conclusion.
We find the defendant guilty of involuntary manslaughter. Thank you for
Crumbley was accused of failing to secure the gun and ammunition at home. Her husband faces a separate trial. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
from Bloomberg World Headquarters, I'm Charlie Pellet. 4:40 is the time right now on Wall Street, and we begin with a developing story. Headlines, as we just reported, Disney's ESPN, Fox, and Warner Brothers Discovery are joining forces to launch a sports-focused streaming service that will feature major college and pro games. Now, this service will be 1/3 owned by each company. Pricing and a name for the service have yet to be determined. After hours, we do have shares of the Walt Disney Company. They are trading lower now by just about 1.1%. Snap shares, they are down 30.1%. Snap Inc. reported disappointing revenue in the holiday quarter as the company continues to reel from a slump in the digital advertising market. Again, Snap shares, they are down lower by 30.1%. Amgen expects revenue to jump as much as 20% this year as the purchase of Horizon Therapeutics boosts the company while it works to become a major competitor in the weight loss drug market. And Ford posted fourth quarter results that soundly beat expectations. After hours, we got Ford shares trading higher, Ford up by just about 6%. Turned out to be an up day today for the Dow, the S&P, and the NASDAQ Composite Index. We had stocks eking out a gain at the end of the day. S&P 500 index today higher by 11 points, up by about 0.2%. Dow Jones Industrial Average up 141, up by 0.4%. And NASDAQ overcame earlier losses to finish higher today with just about 11 points, up by 0.1%. So it turned out, as I mentioned, to be an update. 10-year yield 4.08%, the 2-year 4.39%. What about those bets on when the Federal Reserve will be cutting rates, as well as that recession call? That question today for Liz Young, head of investment strategy at SoFi, who was a guest right here on Bloomberg Business Week.
We spent most of 2023 looking around the corner for a recession that didn't happen. And now in 2024, it seems like the market is declaring that it's never coming. And I don't think that either of them will prove to be correct.
Big day for Palantir shares, up today by 30.8%. Spot gold up $10 the ounce to $20.35, up 0.5%. I'm Charlie Pellet. That's a Bloomberg Business Flash. Carol and Tim, back to you.
All right. Thank you so much, Charlie Pellet there. Well, today, Treasury Secretary Janet Yellen said that while losses in commercial real estate are a worry, U.S. regulators are working to ensure that loan loss reserves and liquidity levels in the financial system are adequate to cope. Essentially worried about how much is on banks' balance sheets. That's what she was addressing.
Well, one big player in the commercial real estate industry is the Canadian asset management giant Brookfield. The company owns more than 700 properties around the globe, makes it one of the world's biggest owners of commercial property. $865 billion under management. Brookfield is second only to Blackstone among alternative asset managers.
Yeah, and Tim, as office values languish and higher rates persist, Brookfield finds itself at the center of a global real estate shakeout. In fact, it's still, though, raising a new real estate fund even after defaulting on more than $3 billion of U.S. commercial mortgages. That is top of mind when we bring in John Gittleson.
Yeah, he's part of the team that writes about Brookfield today. He's Bloomberg News real estate and investing reporter, as well as Los Angeles bureau chief. He joins us from our Los Angeles bureau right now. So, John, let me get this straight. Brookfield defaulted on more than $3 billion of U.S. commercial mortgages in recent years, and now it's going back to investors saying, we want to raise billions of dollars more from you to go and buy the same thing?
Well, they're saying it's not the same thing. They're saying now is a great time to invest because they will be able to buy office buildings, malls, and other kind of properties that they like at a discount compared to what they would have been a few years ago. And they also say, hey, everybody buys a whole bunch. Nobody bats 1,000. So these defaults are de minimis as far as our, total investments, and that put your money with us because we know what we're doing.
Are they right to say that? What do folks or investors in their funds say?
Well, I mean, that's what's interesting. That's why you play the game,
That's fair.
But their argument is they take a very value-oriented approach to investing. And they say the best time to buy is when other people are over-leveraged or mismanaged real estate, and we can get assets that have long-term value at a good price. Others in real estate take more of a growth approach to what they're investing. And they're saying there's too many office buildings, for example, out there. There's a lot of malls that are, zombie malls that aren't worth money. So they're putting money into industrial real estate, into data centers, into types of real estate that are undersupplied and have a growth story to them. And so it's really interesting kind of comparing it to stocks. Brookfield is like the value investor, whereas other companies are more the growth investor, thematic investments.
Hey, take us through the structure here of Brookfield, and Brookfield Corp and Brookfield Asset Management. So what's going on with these two separate but related companies?
Feel free to bring in a whiteboard behind you.
Yeah, I feel like I need to.
That's okay.
Type of thing.
We like props. Go ahead.
Yeah, that would have been a good idea. I should have prepared a sort of org chart. But there's a parent company that is now called Brookfield Corporation. There was a spinoff that's called Brookfield Asset Management. And essentially, Brookfield Asset Management, which is 75% owned by Brookfield Corporation, manages outside investors' money and all of their separate funds. Brookfield currently has a real estate fund that they're raising, an opportunistic fund. Their target goal is $15 billion. This is like a closed-end private equity type fund. And they've raised about $7 billion so far. Brookfield also has an insurance or multiple insurance affiliates. They do infrastructure investing. They do energy investing. It's a very diversified company, but real estate is their biggest segment. And there are all kinds of interwoven parts and affiliates of this company.
We're laughing about the structure, but I mean, why is it important? I'm thinking about our audience who's listening or watching right now. Why is it important to is it convoluted? Is it not transparent as a result of it? Why is it important that we're pointing this out, John?
It's important to point it out for a couple of reasons. One is it is hard to say, it's important to say which part of Brookfield owns something. If it's part of one of these funds, which have a term typically of about 10 years, they're shorter term, they're more opportunistic. If the assets are owned by their by their insurance affiliate or by the parent corporation, they are more long-term investors. And sometimes what they have done is transferred properties from one of their shorter-term funds to their insurance affiliate or the parent corporation. And that way they can return money to investors in these funds, and they can hold on to a property over the longer term without necessarily having to sell at a time when the market is not paying the price that they think they could get if they hold on to longer. And a lot of these are income producing properties that they figure, hey, we can keep collecting rent, making money on these properties rather than being forced to sell to repay investors. So it works for them, but it also is a concern of investors who may think, are our interests aligned with theirs? Mm-hmm. Are they playing, accounting games by moving stuff from one segment of the company to another?
Hey, let's just end talking a little bit about Bruce Flatt. I was so surprised to read in your story that he became CEO of Brookfield Asset Management in 2002. And this is a guy who was in his 30s when he became CEO.
Correct. That was 21 years ago. He's 58 now. So do the math. Anyway, yeah, he was very young. I mean, he's been nicknamed the Warren Buffett of Canada, or Canada's Warren Buffett. He's a very, not a real colorful guy. His name is Flatt. But he also has a long track record and, very shrewd, building this company from what was once a small, I wouldn't say small, but, he's definitely managed to grow it. And his value investing theme is a really strong, it's done very well by him.
Listen, and he's raising money for that new fund. And either the bet's going to be a smart one, and I guess time will tell ultimately about this. John, this is an incredible story. John Gittleson, another one from John, LA Bureau Chief, real estate investing reporter at Bloomberg News, joining us from our LA Bureau. Find it at Bloomberg.com or on the Bloomberg Terminal.
your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Disney's ESPN, Fox, and Warner Brothers Discovery are joining forces to launch a sports-focused streaming service that will feature major college and pro games. The service will be a third owned by each company. Hertz missed analyst estimates in the fourth quarter as it sold down its fleet of Tesla EVs, citing high repair costs and a drop in residual value. The drop follows the company's decision to offload 20,000 Tesla EVs, about a third of its electric fleet, saying it lost money renting them out. BP today surged to a 2-month high after accelerating share buybacks as the company's new boss sought to woo investors that have been skeptical of its clean energy strategy. Javier Blas is a Bloomberg opinion columnist who is focused on the oil industry.
Big oil is performing. I think that one of the things that is very good is that companies are reining on capex, and they are also starting to reduce operational expenditures. They are making their balance sheet a lot stronger, and therefore they can perform in environments of oil prices which is still elevated, $75, $80 a barrel, but nothing like the $100 plus of the last couple of years.
And today we did have crude oil advancing up by 1%. Shares of oil majors also advanced today. ADRs of BP up 6.3%. ExxonMobil up 0.7%. Chevron today up by less than 0.1%. JP Morgan Chase plans to open more than 500 new branches and hire 3,500 workers over the next 3 years, expanding into additional markets that include low-income and rural communities, as well as locations aimed at the rich. And those are our top company stories at this hour. I'm Charlie Pellet, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
It is Bloomberg Business Week on this Thursday. You wish, Carol. Wednesday afternoon. Tuesday afternoon, that's what it is. Hey, did you see the breaking news earlier?
Yeah, listen, it got our attention. Walt Disney's ESPN, Fox, and Warner Brothers Discovery joining forces to launch a sports-focused streaming service that will feature major college and pro games.
Yeah, the service is going to be 1/3 owned by each company. Pricing and a name for the service have yet to be determined. We've got Bloomberg News' Chris Palmieri with us right now from our Los Angeles bureau. Chris, good to have you with us. I got to tell you, the first thing I saw when I saw this headline and I read the story that you wrote up was the early days of Hulu and the ownership structure of Hulu way back in the day when all these companies got together and said, we got to get online. What's going on with this one?
In fact, I had this tip a week or so ago, and I wasn't able to confirm it, but in fact, my source had told me that this was being called the Hulu of sports. I think that ultimately, although the Hulu has grown into a very successful business, I actually think this will be even more of a watershed moment in TV history because so much of the cable bundle was tied to live sports. That was the reason you had to pay $100 a month to Comcast or Charter. And this is, going to take away the need for that. If you're a diehard sports fan, you can just subscribe to this. There's going to be ways to add on, Disney Plus or Hulu or some other Max and this is just going to be another big nail in the coffin of pay TV.
Chris, is this just also, though, it's so expensive to go it alone? And I mean, these are guys who are competitors, right? But is that why, this kind of band of brothers or band of streaming brothers, if you will, that they're doing it together?
Yeah, each of these companies sort of has a different reason for doing this. We'll take Fox, which doesn't really have a big streaming service like the other guys.
True.
This is a way for them to get some more money for their sports content and also, have a toe in the future because they're really more focused on traditional broadcast. Warner Brothers is kind of a little bit of both. They've, got Max, the streaming service, and they're adding sports to that. But, they also are looking for other ways to generate money from their huge outlays on sports. ESPN's Disney is kind of the real kind of interesting thing, and we'll see what Bob Iger has to say about this on earnings on Wednesday because, they were talking for a long time about taking ESPN direct as a consumer product. I'm not sure why they would need to do that at this point because it's bundled inside of this service.
Hey, Chris, Who's the biggest loser here? I'm looking at shares of Comcast in the after hours, down about 0.5 percentage point. Charter Communications down about 0.7%, though Charter was down about 5% today. I would expect kind of a bigger reaction in the post-market after news like this.
Me too. We'll see what happens tomorrow. But yeah, I think the traditional cable and satellite guys are probably the biggest losers. I think I saw Fubo TV, a smaller company that aggregates sports rights, also took a dive. You know, I think I saw mixed reactions from some of the partners in this. Disney may even be down a little bit because people were expecting more of a direct play from them that they would own the majority of.
Well, and it's
So,
interesting. It's interesting too, right, Chris? Because Disney, I thought, has been thinking about possibly getting rid of, right, its TV station. It's interesting to see Disney doing this, right, or their ESPN unit doing this, and then I wonder if it just is more confirmation that they might ultimately kind of get rid of all of their TV stations. Just got about 20, 25 seconds here.
Yeah, I don't necessarily see this as a sign that they would get rid of it. Just another commitment to streaming and another goodbye to traditional TV.
Really interesting, right? And other headlines. Chris obviously reporting, Journal also reporting. Stream venture will include NFL, NBA games. So it's pretty interesting how things are changing.
It's amazing it took this long, but the rights issues have been huge also.
I bet.